in the European central banks, there's probably something like 7,000-8,000 tons of gold. They could raise $2 trillion and solve their problem and sell these gold-backed bonds to China, which is sitting on 3.1 trillions of foreign exchange and doesn't get any returns for it. So I think that the idea of using the gold that they have in their vault is going to come to pass, and that, to my mind, is going to be a very good thing for the industry.
Indeed, we have seen an increasing focus on the financial or the monetary aspect of the gold market. Some people on the extremes are talking about a return to the gold standard. Others have talked about the use of gold as collateral. How do you see it developing? Only to a point where you see central banks having gold-backed loans, or do we see, or do you see it advancing further than that?
There's no question that the advent of the gold ETF by the World Gold Council in 2004 became the vanguard of gold as a financial asset. And then just a few weeks ago, for example, the big clearinghouse in Europe have accepted to use gold as collateral for banks. I believe that the various countries, whether it's Italy in particular or other, will end up using gold as collateral for loans, and that gold is truly becoming what it has always been. Partly, gold is partly a financial asset, partly a commodity through the jewelry sector. But in today's environment, 50% of all the gold sold last year went to the financial sector, and it may be even more in 2011 and 2012 as the public essentially decides to use gold as a currency versus putting their money in U.S. dollars or putting it in euro. So I think that whole sector is going to continue to develop. And when you look at the total amount of wealth in the world, only 1%, or about 30,000 tons of gold, is represented by gold. And so when I look out over the next 10 years, I think that proportion could easily double, and that will create demand for another 30,000 tons of gold over the next 10 years. When I look as well at the Asian central banks, they only started buying gold in the last few years, but now you look at the first 6 months of this year, the central banks have bought 200 tons of gold. You annualize that, it's 400 tons of gold, vis-a-vis, even 5 years ago when central banks, mostly Europeans, were selling 400 tons of gold. So that's like a huge reversal in the gold market. But when you look at the Asian central banks, if they want to get up to 15% of reserve, as, for example, the recommendation of when the ECB came into being, they will need to buy a minimum of 7,000 tons of gold, and more likely it's going to be more than that. So I'm very, very positive on the gold market looking out over the next 5-10 years.
Where is that gold going to come from?
Well, now that's a very, very good question. I don't believe in peak gold. I think that there is huge amounts of gold to still to be discovered. But you are pointing to a real problem, because when you look at the discoveries of the last 10 years, there's two things that are very apparent. One is the quality of the discoveries are nowhere near what we saw in the 80s and the 90s. Today we talk about discoveries, open pit 1 gram, 1.5 gram, and people are all excited. When you think of Ghost Strike that Barrick discovered, we were talking, 10 grams open pit, 20,000 ton a day. I mean, that was incredible. Hemlo, like 20 million tons at 1 ounce gold. You imagine a discovery like that today? We haven't seen any of those in like 15 years. So what's happened is the big mining companies have dropped their grades to be able to keep production. Because if you look at production this year versus 10 years ago, it's the same. Hasn't moved. The reality is it's actually gone down for 7 years, and in the last 2 years it's perked back up again because they've dropped the grade, they've increased the size of the pits, but the profit margins up to about $1,200 gold had not really changed. So why pay more for equity, for example, when your profit margin is the same at $1,200 as it was at $400 gold? This is what's really happened with the gold mining industry. And then the second part is that the industry has just not discovered the number of large deposit that it did back in the 80s and the 90s. Back then, at least every 10 years, someone found a 50-plus million ounce deposit. Well, we haven't seen one of those since Yanacocha back in 1993. The industry found a minimum of 3 to 5, like 15 to 30 million ounces a year deposit every year. Well, in the last 10 years, I think we're lucky if we found like 5 of those. So there is a real issue. I believe the mining industry will have to spend a lot more money in exploration, R&D, research and development, and exploration itself. But I think the deposits are out there. But the cycle will, before you see, real increase in production. I mean, like plus 4 or 5% per year. It might be 10, 15 years down the road. I think for the next sort of 5 to 10 years, you're not looking at more than 1 to 2% per year maximum. So the pressure will stay on the gold price. That's what's going to happen.
Pierre, how much of this has to do with the fact that it's almost easier now to buy up an explorer than go out and explore for something oneself, and with valuations where they are, where we have seen relatively, or at least from my kind of viewpoint, that there does seem to be a dislocation between where gold prices are and where gold equities are, and perhaps the assumption being, well, it might be easier to buy somebody that's done a little bit of exploration work already than to go out and explore for oneself.
Well, that's always been the case, Jeff. The big companies have always, bought either the intermediate or the junior, and that's not going to change. But the problem is the quality of the deposits that are found. If they're not any better than what they already have, why buy them? And I think that's a good part of why I think we're not seeing as much M&A as you would have expected. For example, I think in the 80s and 90s you saw a lot more of it, but it's just not that exciting. I think that's the problem.
I was speaking to Evie Hambro from BlackRock a few weeks ago, and he was talking about part of the problem being in terms of the gold equities is that investors, and particularly the more generalist investors that have come into the space recently, want to see management being able to manage their cash flows and see kind of a return, perhaps dividends, those kinds of things, before they start buying the stock and re-rating the stock. What is your view of how gold equities are being perceived in the market at the moment? Well,
I think that the number one issue that's missing is excitement in the large cap or even the medium capitalized stock in terms of discoveries and earnings growth. And then yes, there is a disconnect between the equity price and the gold price. But that disconnect can almost be entirely accounted for by the analysts' projections of the gold price and what they use to calculate net asset value for mining companies. Most analysts are using their economist projections for gold, and for the last 10 years, it's always been way under the reality. For example, today the average is probably looking out, for example, 5 to 10 years, they're using $1,100 gold. vis-a-vis a real gold price of 1,600. So, what do you expect? Like, they put out a recommendation using $1,100 gold. So therefore, the price that most of the stocks are trading at on a net asset value is around $1,100-1,200 gold. And that is not going to change until either the street uses, today's gold price, or even, the contango. But they're not using it. I think dividends are nice. I love dividend, but I think the plain reality is that most people buy gold stocks because they believe gold's going to go up. And, I think dividend is only a small part of why the gold stocks have not performed. I don't think that it's a major part of it.
Pierre, looking briefly at the investment side of the gold market, and it's something we've spoken about before, do you think we're increasingly seeing almost a legitimization of gold investment on the part of people that perhaps weren't looking at gold even as something or as a place to put their money?
Well, certainly with the performance of gold over the last 10 years, it has been either the best or certainly one of the best performing financial asset. There are more and more people looking at gold. However, they look at gold from 250 to 1650, and then now they're, have I missed the entire bull market? They want to be securitized. They want to be told, what is happening in the market. They need there's the famous wall of fear in front of them. And that has to be explained and described to the people. But when you look at the U.S., for example, the vast majority of pension funds and mutual funds do not own any gold stocks. The vast majority of them, and part of it is the fact that the industry in the U.S. is almost irrelevant in terms of the size of the U.S. economy and in the size of like the New York Stock Exchange. I mean, there's really only two stocks that they look at, and it's either Newmont or Freeport, which is even more copper than gold. So, there's no gold index. There's no real relevant, and then there's very, very few analysts. None of these funds have any internal knowledge about gold. They truly are generalists, and they look at gold strictly from an earnings standpoint, and the way they would look at an industrial stock. And for them, only in the last few months, the gold stocks have come back into a range where they would see a buy, because they can buy them for 6 times earnings, 8 times earnings. But when you talk about stocks that are trading at 40 times earnings, and they look at it as industrial stock, forget it. They're not even going to look at it. So I think that's all part of the issue why the major cap stock have not performed as well. But if you look back again at the 66, 1980 bull market, there was one really severe pullback from 1974 to 1976, where the gold price went down by 50%. Could we have one of those in the next few years? I think yes and no. I think that pullbacks in the 15 to 25, maybe 30% range is not out of the question. Especially if China, which is the destination of 60% of all the commercial gold sold today, has a hiccup. I think that yes, you could have one of those, but at the same time, because of central bank purchasing, because of the very deep pockets waiting on the sideline on any retracement for financial purpose, I think that I don't see a 50% retracement in the gold price.